Nike's CEO is facing a direct challenge to his authority. Activist investors controlling billions in capital are demanding his removal. The company's board is fractured. Employees have been laid off by the thousands, and in a matter of days, a shareholder vote will decide whether the most powerful figure in global sportswear keeps his job or loses control of the brand he was hired to protect. The stakes: Nike's $140 billion market value, the future of its product pipeline, and the credibility of its leadership. Wall Street is no longer asking for change, it's demanding it. We cannot support a leader who has lost the confidence of both the market and his own team, reads the letter from the activist group, circulated in the boardroom as directors sit in tense silence. This confrontation has exposed a fundamental contradiction at the heart of Nike's governance. The company built its dominance on relentless innovation and cultural cachet, but under pressure to deliver short-term financial results, leadership pivoted to aggressive cost-cutting. The result? A series of failed product launches, declining morale, and a growing sense that Nike's creative engine is stalling. The board's loyalty is now split between a CEO promising discipline and investors demanding a return to growth at any cost. Nike's position as the world's leading sportswear brand is not in question. What matters is how quickly that position can erode. Over the past 2 years, Nike's stock has underperformed the S&P 500 by more than 30 percentage points. The company has announced multiple rounds of layoffs, eliminating over 2,000 jobs. Key product lines, once the envy of the industry, have missed sales targets. The self-lacing Adapt BB basketball shoe, hyped as a breakthrough, failed to gain traction and was quietly discontinued. Meanwhile, rivals like Adidas and Lululemon are gaining ground with high-profile launches and surging sales. The market is no longer willing to accept excuses. The mechanism driving this crisis is simple: a leadership bet on efficiency over innovation. Facing slowing growth and rising costs, Nike's CEO initiated a sweeping restructuring. Budgets for research and design were slashed, marketing spend was cut, entire product teams were dissolved. The goal was to protect margins and reassure Wall Street that Nike could deliver predictable profits. But the trade-off was immediate. New product launches stumbled, signature lines failed to resonate. The company's ability to set trends, its core advantage, was quietly sacrificed for quarterly stability. This strategy might have worked if the market had stayed static. Instead, consumer tastes shifted rapidly. Competitors seized the moment, launching bold new designs and capturing market share. Internally, the layoffs triggered a wave of departures among senior designers and product managers. The creative pipeline slowed to a crawl. When Nike's longtime head of women's apparel abruptly resigned after her team's flagship line missed targets, it sent a clear signal. The internal exodus was accelerating. Nike's reputation for innovation, carefully built over decades, began to look fragile. Investors noticed, so did the board. The inflection point came when a coalition of activist investors, led by a major hedge fund, went public with their demands. They accused the CEO of managing for the quarter and abandoning the company's founding principles. Their campaign was not subtle. They called for a new leadership team, a renewed focus on product, and a reversal of the cost-cutting measures that had gutted Nike's creative core. The board, already divided, was forced to choose sides. The CEO's authority, once unquestioned, became conditional on surviving the upcoming shareholder vote. At this stage, the options narrowed. Reversing the cost cuts would mean admitting strategic error and risking further profit declines. Staying the course would almost certainly trigger a leadership change. The board's attempts to broker a compromise failed. The CEO's fate now rests on a single vote, one that will be decided by institutional investors weighing short-term returns against long-term brand value. The outcome is uncertain, but the damage to Nike's internal cohesion is already done. This episode is not unique to Nike. It reveals a structural vulnerability in any company where creative output is the primary source of value. When leadership prioritizes efficiency over innovation, the resulting decline is rarely immediate, but it is often irreversible. Activist investors, empowered by concentrated shareholdings and public campaigns, can force a reckoning, but their incentives are not always aligned with the long-term health of the brand. The board, caught between competing visions, becomes a battleground rather than a source of stability. The lesson is clear. In industries where brand and product are inseparable, cost-cutting is not a neutral act. It is a bet against the company's own future. Once creative momentum is lost, it cannot be restored by mandate or by memo. The shareholder vote at Nike will determine who holds power in the short term. But the deeper question, how to balance financial discipline with creative risk, remains unresolved. Nike's crisis is a warning. When the mechanisms of corporate governance reward predictability over possibility, even the most iconic brands can find themselves on the defensive. The outcome of this power struggle will be measured not just in share price, but in the company's ability to shape culture and to survive the next shift in consumer taste. Capital rifts, where money breaks